Canadian Natural Resources Limited, CNQ, a major integrated energy producer, examining its operational distinctiveness, financial resilience, and capital allocation framework. The analysis confirms CNQ's differentiated position within the North American energy complex, underpinned by assets that mitigate cyclical risk. 1.1 Investment Thesis Summary. The core of the investment thesis resides in the company's strategic shift toward a long-life, low-decline L3D asset base, which includes its world-class oil sands mining and upgrading operations and vast thermal in-situ opportunities. This structural advantage enables superior and sustainable free cash flow (FCF) generation across diverse commodity cycles. This FCF durability is reflected in the company's unparalleled Total Proved Reserve Life Index (RLI) of approximately 32 years. Management's transparent and disciplined FCF allocation policy provides a quantifiable catalyst. Once the critical net debt target of $12 billion is met, 100% of FCF will be directed toward shareholder returns, initiating a significant re-rating event. Furthermore, CNQ's balanced production mix of heavy oil, light oil, bitumen, and natural gas offers crucial portfolio diversification. This is particularly relevant as the company stands to benefit substantially from the forecasted recovery in AECO natural gas prices, offsetting expected near-term weakness in WTI crude oil prices in 2026. CNQ is currently undervalued when accounting for the longevity of its assets and its growth profile. The company's price-to-earnings (PE) ratio on a trailing 12-month TTM basis is 14.7x, aligning with the Canadian oil and gas industry average of 14.7x. However, a superior measure, the enterprise value (EV) to EBITDA multiple, stands at 6.2x for CNQ, notably lower than the industry median of 7.4x. This favorable multiple suggests that the market has yet to fully price in the operational resilience and superior FCF quality inherent in the company's enterprise value structure. The attractiveness is further confirmed by a low forward PEG ratio of 0.86, indicating that the stock is inexpensive relative to its estimated future earnings growth rate. The unparalleled longevity provided by the 32-year RLI serves as a structural underpinning for a valuation premium over conventional high-decline peers. 1.3 Key Investment Risks. Commodity price volatility. Despite the diversified asset base, CNQ remains sensitive to global crude markets. Industry forecasts, including those from Goldman Sachs and the EIA, project a potential decline in WTI crude prices to the $52 to $55 per barrel range in 2026, driven by a global supply surplus. Such price deterioration would compress margins and decelerate the progress toward the crucial $12 billion net debt threshold. Regulatory and decarbonization capital requirements. Canada's intensifying focus on climate policy, including the federal industrial carbon pricing system, introduces material long-term financial risk. While CNQ has committed to an aspirational target of net zero emissions by 2050 via the Pathways Alliance and set a corporate 40% GHG reduction target by 2035, mandatory capital expenditures for large-scale carbon capture projects could divert substantial future FCF away from shareholder returns. Integration and operational cost inflation. Margin pressures and rising operating costs were already observed in the third quarter of 2025, contributing to a year-over-year fall in net income. Successful integration of recent large acquisitions, such as the Albion Oil Sands Project ASOP swap and the Montney assets, is essential to realize anticipated efficiencies and maintain the company's industry-leading cost structure in the face of persistent cost inflation. 2.1 The Long Life Low Decline L3D Model. Competitive Advantage. Canadian Natural has strategically transitioned its portfolio to an asset mix that maximizes long-term cash flow sustainability. This is centered around its long-life, low-decline L3D assets, which represent a structurally superior business model compared to conventional exploration and production (E&P) companies. Asset quality. The foundation of the L3D model lies in the company's vast oil sands and thermal in situ opportunities. A critical measure of this advantage is the low corporate production decline rate, estimated at approximately 11%. This low rate is primarily attributable to the stability of the oil sands mining and upgrading assets, which boast an effective 0% decline rate. In contrast, CNQ's conventional E&P production, some 43% of total production, typically exhibits a steeper some 19% decline. The fact that approximately 57% of CNQ's production is classified as long-life low-decline production means the overall portfolio requires significantly less capital reinvestment merely to sustain current output. This structural efficiency mechanically maximizes the volume of FCF generated per barrel compared to peers with higher decline portfolios. Reserve longevity. The longevity of CNQ's resource base is exceptional. The company reports a total proved reserve life index of approximately 32 years. This RLI is calculated using 2024 net proved reserves based on SEC constant prices divided by the estimated 2025 proved developed producing net production. This figure is double the peer average RLI of approximately 16 years. The significant portion of these reserves classified as high-value synthetic crude oil, light crude oil, and natural gas liquids reinforce the sustainable cash flow base. The robustness of this reserve profile allows CNQ to adopt a flexible capital budget focusing on maximizing corporate asset value and cash flow throughout all cycles. 2.2. Operational performance and asset mix. CNQ's operational execution remains top-tier, consistently achieving high utilization rates and low operating costs, particularly in the oil sands. Q3 2025 production records. In the third quarter of 2025, CNQ achieved record quarterly production volumes totaling approximately 1.62 million barrels per day. This record was driven by both organic growth and accretive acquisitions completed over the preceding 12 months, resulting in a substantial 19% or approximately 257,000 BOPD increase from Q3 24 levels. Record volumes were achieved for both liquids 116 million barrels per day and natural gas 2668 million MCF per day. The performance of the world-class oil sands mining and upgrading assets was especially strong, with production averaging approximately 581 million barrels per day of SCO. Crucially, the utilization rate for these complex assets averaged 104%, an exceptional level of operational effectiveness. This high utilization rate is essential because it effectively dilutes fixed costs across a larger production base, contributing directly to the industry-leading operating cost metric of approximately $21 per barrel for SCO. This low operational cost floor protects the company's margins against potential near-term crude price volatility and ensures sustainable profitability. 2.3. Strategic asset development and recent acquisitions. Management has demonstrated a strategic focus on bolstering the core L3D assets while simultaneously adding short-cycle, high-return conventional opportunities. Subsequent to Q3 25, on November 1, 2025, Canadian Natural closed the ASOP Albion Oil Sands Project swap with Shell Canada Limited. This pivotal transaction gives CNQ 100% ownership and operatorship of the Albion Oil Sands mines, while retaining an 80% non-operated interest in the Scotford Upgrader and Quest facilities. This swap immediately generated additional cash flow and added approximately 31,000 barrels per day of annual zero-decline bitumen production to the company's portfolio. This influx of zero-decline production strongly reinforces the L3D foundation, generating stable cash flow and inherently reducing future capital reinvestment needs. Furthermore, operating the mines entirely allows CNQ to integrate equipment and services across its entire mining portfolio, unlocking additional efficiencies through continuous improvement initiatives. Conventional acquisitions. Earlier in 2025, CNQ completed two significant conventional acquisitions. The Palliser Block assets, closed June 26, 2025, and the Grande Prairie Montney assets, closed July 2, 2025. The Palliser acquisition added approximately 50,000 BOE/d, 20,000 BBLs per day light oil and NGLs, and 1.1 million net acres of high-quality land. The Montney acquisition added approximately 32,000 BOE/d, 12,500 BBLs per day of NGLs, and 120,000 net acres. These additions, particularly the short-cycle, high-return Montney gas assets, provide the company with critical capital flexibility. This enables management to quickly ramp up production when commodity prices strengthen, complementing the stable base-level production provided by the L3D assets. The strategic acquisition of short-cycle, flexible assets financed by FCF demonstrates disciplined asset allocation designed to maximize long-term shareholder value. 3. Financial performance and cash flow dynamics. 3.1 Historical financial trends. Canadian Natural has historically demonstrated high profitability and cash flow generation, although net earnings can fluctuate significantly due to non-cash items and margin cycles. Revenue and earnings history. Over the past decade, CNQ has experienced periods of substantial growth. Revenues have been growing at an average rate of 11.2% per year. Net margins have generally been robust, currently standing at 17.2%. However, the company's net profit margins are noted as being lower than the previous year, 17.2% currently versus 21.3% last year. Trailing 12 months TTM revenue ending September 30, 2025 was reported at $27.593 billion, reflecting a 5.05% increase year over year. Crucially, despite executing additional activity following an increased asset base size, the 2025 operating capital forecast remains unchanged at approximately $5.9 billion. This demonstrates a high degree of capital discipline and efficiency, allowing for production growth, increased 2025 guidance to 1,560 MBOED to 1,580 MBOED without corresponding capital inflation. 3.2 FCF generation and margin analysis, Q3/25. The third quarter of 2025 highlighted the operational strength of CNQ, but also demonstrated financial volatility driven by non-cash charges. In Q3/25, the company generated robust adjusted funds flow of approximately $3.9 billion. However, net earnings for the quarter were constrained, totaling approximately $0.6 billion, primarily reflecting a significant non-cash recoverability charge of approximately $0.7 billion related to an increase. The stability of CNQ's AFF generation, even when net earnings fluctuate due to non-cash charges, is a direct outcome of the L3D business model. This sustained cash flow permitted the return of approximately $1.5 billion to shareholders in the quarter, signaling ongoing confidence in the underlying cash generation capacity despite quarterly volatility. A deeper examination of the balance sheet activity reveals that the strategic use of FCF temporarily paused aggressive debt reduction in Q3/25. While cash flow from financial activity was highly negative in the TTM ending June 30, 2025, negative $9.853 billion, reflecting massive deleveraging efforts, the company reported remaining at similar net debt levels when comparing Q2/25 to Q3/25. This decision illustrates a tactical deployment of cash flow away from maximum speed toward the $12 billion target and toward funding the accretive acquisitions, AOSP, Palliser, Montney, that enhance the long-term quality and sustainability of the cash flow base. Furthermore, financial margins in Q3/25 were impacted by rising borrowing costs. The company's average effective interest rate increased for the 3 and 9 months ended September 30, 2025, averaging 5.2% and 5.1% respectively. This increase was a function of higher floating rate long-term debt held during the period. The rising interest expense adds a layer of variable cost contributing to the overall margin pressure, underscoring the urgency and financial benefit of reducing net debt to the $12 billion target to minimize exposure to interest rate fluctuations. I. Balance sheet strength and capital allocation policy. 4.1. Credit profile and debt management. CNQ maintains a strong, sustainable balance sheet essential for weathering cyclical industry downturns. The company holds investment-grade credit ratings, including a Baa1 stable rating from Moody's and a recent BB+ stable rating from Fitch Ratings. This favorable credit positioning minimizes financing costs and ensures robust access to capital. As of September 30, 2025, CNQ reported approximately $4.3 billion in liquidity, including committed and undrawn credit facilities, cash balances, and short-term investments. During Q3/25, the company continued its debt management efforts by repaying $600 million. Long-term debt management has been successful, with total net debt decreasing from 13,950 million CAD in 2021 to 9,922 million CAD in 2023. 4.2 Structured FCF Allocation Policy, Catalytic Framework. Canadian Natural operates a highly transparent and predictable free cash flow allocation policy tied directly to explicit net-net thresholds, acting as a major capital return catalyst. The policy is tiered as follows. Net debt $15 billion or above, FCF is directed primarily toward debt reduction. Net debt between $12 billion and $15 billion, FCF is split, with 75% allocated to shareholder returns and 25% allocated to the balance sheet. Net debt at or below $12 billion, 100% of FCF is allocated to shareholder returns. This structured approach ensures that the company maximizes returns only once the balance sheet is secured against major economic shocks. By explicitly linking maximum shareholder payouts to the achievement of a low net debt target, CNQ effectively minimizes its financial risk, guaranteeing stable financial resilience Baa1/BB+ credit status regardless of near-term market fluctuations. This policy structure is designed to yield superior shareholder returns when commodity prices are strong. FCF is approximately 30% higher at $85 WTI versus $75 WTI, while protecting the financial base during downturns. 4.3 Shareholder Returns, Dividends and Buybacks. Shareholder returns are a cornerstone of CNQ's value proposition, delivered through both a consistently growing dividend and flexible share buybacks. CNQ is recognized as a leader in dividend growth within the energy sector, currently paying an annual dividend of $1.71, equating to a 5.10% yield. Management's confidence in the long-term stability of the L3D cash flow is demonstrated by the phenomenal annualized dividend growth rate of 21.56% over the last 5 years, encompassing 18 dividend increases. The dividend payout ratio remains highly sustainable at 66% of earnings. In addition to the dividend, share repurchases are employed dynamically to manage discretionary FCF allocation. In Q3/25 alone, CNQ returned approximately $1.5 billion to shareholders, comprising $1.2 billion in dividends and $0.3 billion in share repurchases. Year-to-date up to early August 2025, total returns were approximately $4.6 billion, including $3.6 billion in dividends and $1 billion in share repurchases.
The company maintains an active share repurchase program, having increased its authorization by $100 million to an aggregate total of $500 million worth of shares, expiring in June 2027. This preference for buybacks over accelerated dividend hikes is a strategic advantage. It allows the company to maintain a foundationally secure, growing dividend while using buybacks to substantially boost the total yield, reaching 10.93% in 2022 when FCF surges, thereby optimizing shareholder value based on prevailing market conditions and cash flow fluctuations. I. Macroeconomic environment and industry risk assessment. 5.1 Commodity Price Sensitivity and Forecasts 2026 through 2028. CNQ's operational profitability is directly exposed to global and regional commodity price movements. Current forecasts suggest mixed performance in the near term. Crude oil outlook. The outlook for crude oil prices in 2026 is cautious. Goldman Sachs anticipates a significant global supply surge resulting from long-cycle projects approved pre-pandemic, leading to an estimated surplus of around 2 million barrels per day. Consequently, the bank forecasts West Texas Intermediate (WTI) crude will average $52.
Natural gas outlook. In contrast to the bearish crude outlook, Canadian natural gas prices are projected for a sharp recovery, providing a significant counter-cyclical stabilizer for CNQ, one of Canada's largest natural gas reserve holders. The AECOC natural gas price, which averaged a depressed $1.45 per gigajoule (GJ) in 2024, is forecast to rebound sharply in the Alberta Energy Regulator's base case, rising to $2.71 per GJ in 2025 and further to $3.82 per GJ in 2026. S&P Global corroborates the rising trend, forecasting AECO at $2.25 per MMBTU in 2026 and $2.50 per MMBTU in 2027. This expected recovery is critical for cushioning the corporate adjusted funds flow, AFF, if WTI prices fall to the projected $52 to $55 range. The diversification across liquids and natural gas helps maintain overall corporate cash flow stability, safeguarding the FCF allocation policy. 5.2 Regulatory and Climate Policy Risk. CNQ operates in a jurisdiction with increasingly stringent environmental regulations, posing a major long-term capital risk. FCF allocation conflict. The commitment to aggressive shareholder returns presents a potential conflict with future mandatory decarbonization capital expenditure. Industry analysis suggests that Canadian oil and gas companies have recently prioritized short-term shareholder value via buybacks and dividends, rather than significant investment in large-scale decarbonization efforts to align with Pathways pledges. The current 2025 operating capital budget of $5.9 billion does not appear to incorporate the immense capex required for large-scale projects, such as carbon capture and storage (CCS), necessary to achieve the 2035 40% reduction target. Should government mandates intensify or regulatory delays force CNQ to allocate large, specific capital amounts to emissions reduction before 2035, that FCF will necessarily be diverted from the 100% shareholder return policy. 6. Valuation benchmarking and price target derivation. 6.1 Relative valuation metrics. CNQ's valuation suggests that the market has not yet fully discounted the unique quality and resilience of its cash flow relative to peers like Suncor Energy (SU) and Cenovus Energy (CVE). The analysis of key valuation multiples confirms CNQ's relative attractiveness. P/E ratio. CNQ's P/E, TTM, of 14.7x is comparable to its Canadian peers, such as Suncor, 14.3x, and Cenovus, 15.4x. EV/EBITDA. The superior EV/EBITDA multiple of 6.2x, substantially lower than the industry median of 7.4x, is a significant indicator of undervaluation on an enterprise basis. This low multiple is partially attributable to the market starting to assign a slight infrastructure premium to CNQ's business model.
The 32-year RLI and the high proportion of 0% decline assets significantly de-risk the company's long-term cash flows, reducing the risk premium typically demanded of conventional E&P assets. PEG ratio. CNQ's forward earnings growth of 6.20% is paired with an attractive forward PEG ratio of 0.86. A PEG ratio below 1 implies that the stock is inexpensive relative to its estimated growth rate, reinforcing the view that the company is undervalued. 6.2. Analyst consensus and price target dispersion. The analyst community maintains a strong conviction in CNQ's trajectory, evidenced by the overwhelming consensus rating. Consensus. Based on 20 analysts, the consensus is a buy, with 15 analysts recommending a buy, 7 recommending hold, and 0 recommending sell. Target price. The 12-month average price target is $52.95. Dispersion. The significant range in targets, extending from $47 to $86.95, highlights differing assumptions, particularly concerning the timing of the $12 billion net debt catalyst and long-term commodity price forecasts. The expected achievement of the $12 billion net debt threshold is poised to trigger a significant market re-rating. Once CNQ transitions to the 100% FCF distribution policy, the guaranteed substantial increase in total shareholder yield will inevitably compress the price-to-cash flow multiple. Analysts with targets closer to the high end, C87, are likely modeling an environment where this catalyst is realized quickly, resulting in a valuation surge that accurately reflects the asset base's high FCF conversion capability. 7. Conclusion and recommendations. 7.1. Synthesis and final assessment. Canadian Natural Resources Limited presents a highly compelling investment profile characterized by structural resilience and a quantifiable catalyst for shareholder value enhancement. The company's defining attribute is its long-life, low-decline L3D asset base, ensuring operational efficiency with industry-leading operating costs and a 32-year reserve life. This asset quality enables CNQ to sustain high FCF generation even when commodity prices are weak. The company's strategy of disciplined capital deployment, maintaining a flat 2025 capex target of $5.9 billion despite accretive asset growth, coupled with the focus on deleveraging, provides a clear roadmap for investor returns. The primary near-term catalyst is the achievement of the $12 billion net debt target, at which 100% of FCF will be distributed to shareholders. While the forecasted crude price weakness in 2026 presents a headwind, the expected robust recovery in AECO natural gas prices provides essential cash flow diversification. CNQ's current valuation, especially the low EV/EBITDA ratio of 6.2 and the attractive PEG ratio of 0.86, suggests that the market is not yet fully reflecting the underlying stability of the L3D cash flows. Structural advantage. The L3D model justifies a premium valuation over E&P peers due to its infrastructure-like stability, low corporate decline rate 7.1%, and superior RLI 32 years. FCF catalyst. The pending transition to the 100% FCF shareholder return policy, triggered by achieving the $12 billion net debt level, is the most powerful re-rating event anticipated in the medium term. Valuation. CNQ is fundamentally undervalued on an enterprise basis, EV/EBITDA 6.2, relative to its quality of earnings and proven ability to grow the dividend, 21.56% 5-year CAGR. Investors should consider CNQ an essential core holding within an integrated energy portfolio, providing a rare combination of commodity exposure, exceptional stability, and massive potential FCF yield once the balance sheet target is achieved. The focus should be on tracking the net debt trajectory, which dictates the timing of the maximum shareholder payout commencement.